Good afternoon, everyone. I am Professor Harmanpreet Kaur from Khalsa College for Women, Sidma Khurd. Today, we will discuss the deductions that are available to an assessee out of his gross total income under Section 80 as per Income Tax Act 1961. As we know that income tax is levied on total income of any assessee of a previous year. Assessee means a person who is liable to pay tax. Assessee can be an individual, it can be firm, company, artificial judicial person, body of individuals. First of all, the gross total income is calculated by adding incomes that are covered under various heads of income. As per Income Tax Act 1961, we have 5 heads of income that are salary, house property, business and profession, capital gain, and other sources. Under head salary, the earnings received by individual in form of remuneration, wages, commission are calculated. Salary is a fixed amount of money that is paid to employee by an employer in return of work performed by employee. And moreover, the employee also gets various allowances and perks like house rent allowance, medical allowance, car facilities, car perks, and many more allowances and perks. Next head we have house property. Income earned by individual mainly through rent by letting out his property is covered under this head. Then under business and profession, business basically means activity of purchase and sale of goods with the intention of making profits. Any profits earned under the business are calculated under this head. Profession is occupation that requires intellectual skills. For example, a doctor, a lawyer. So fees charged by doctor, lawyer as per his profession are calculated under this head. Then we have capital gain. Any profit and gain that arises from sale of capital asset are calculated under the head capital gain. Last head is other sources. The incomes which do not come under any of the above heads are calculated under this head. For example, winning from lottery, puzzles, interest received on bank deposits, dividend, etc. So, in order to compute a total taxable income, certain deductions under Section 80C to 80U are available from gross total income. Maximum gross total income for deductions under Section 80 is calculated as, first of all, total income of each head, then all the heads are totaled and gross total income is calculated. Then for deductions, long-term capital gain, short-term capital gain covered under security transaction tax, casual incomes, and incomes referred under Section 115 are deducted from gross total income. Deductions are basically divided into two categories. They can be in form of certain payments or in form of certain incomes. Today we will discuss deduction under Section 80C. There are various saving schemes which can be used by an assessee, in which the assessee can deposit his amount, his income. Section 80C deduction is regarding approved savings in Provident Fund, life insurance premium, and many more saving schemes. The assessees that are eligible for this deduction are individual and HUF, that is Hindu Undivided Family. Under Section 80C, the total amount deposited in various schemes or rupees 1,50,000, whichever is less, shall be allowed as deduction. Then let us start with the various saving schemes that qualify for deduction under Section 80C. First saving scheme that qualifies for deduction under Section 80C is the deposits made in Provident Funds. Provident Fund is an investment fund that is established by employer and employees to serve as long-term savings to support an employee's retirement. So deposits made by an assessee in statutory Provident Fund and recognized Provident Fund are fully qualified for deduction. Means full amount deposited in these schemes, in these funds, is fully qualified for deduction. Next, we have deposits made in unit linked insurance plan. So any payment, any amount that is deposited by assessee in unit linked insurance plans of UTI or LIC mutual funds shall qualify for deduction. Full amount of these deposits is qualified for deduction. Amount can be deposited in the name of assessee, spouse, and children. However, in case of HGF, contribution may be made in the name of any member of HGF. Then next is amount invested in National Savings Certificate 8th or 9th issue. So any amount invested in these certificates is also fully qualified for deduction under section 80C. Next, we have any amount invested in National Savings Scheme 1992 is also fully qualified for deduction under section 80C. Then any amount paid to LIC under Jeevan Dhara, New Jeevan Dhara 1 or New Jeevan Akshay policies also fully qualifies for this deduction under section 80C. Investment in these plans can be made in the name of assessee and in case of HUF in the name of its members. Then amount invested by an individual in the notified funds set up by mutual funds or UTI shall also qualify for deduction, fully qualified for deduction under section 80C. Next is any amount deposited as a subscription to home loan account scheme of National Housing Bank or contribution to any notified pension fund set up by National Housing Bank also fully qualifies for deduction under section 80C. Then any amount paid or deposited as a subscription in the name of a girl child of the individual or in the name of any girl child for whom such individual is the legal guardian will qualify for the deduction under section 80C. Next, we have term deposits with banks. Term deposits with certain banks of not less than 5 years duration and as per the scheme framed by central government shall also qualify for deduction under section 80C. Next, we have payment of tuition fees of 2 children. Any amount paid as tuition fees, whether at the time of admission or thereafter, to any school, college or university or other educational institution situated in India for the purpose of full-time education of any 2 children of the individual, the amount paid as a tuition fees shall be allowed as deduction under section 80C, but it shall not exceed actual amount paid as tuition fee for 2 children. Next, we have payment of life insurance premium. Actual amount of premium deposited by the assessee on his behalf or by his employer qualifies for deduction under section 80C. We have divided the policies in 3 categories. So the maximum limit on LIC premium for deduction under section 80C is divided into 3 categories. First is for the policy issued before 1st April 2012. In this case, actual premium paid or 20% of actual capital sum assured, whichever is less, shall qualify for deduction. Then next we have for the policy issued on or after 1st April 2012. In this case, actual premium paid by assessee or 10% of actual capital sum assured, whichever is less, shall be qualified as deduction under section 80C. Next category is for a policy issued on or after 1st April 2013 on the life of a person with a disability or a disease. In this case, actual premium paid or 15% of actual capital sum assured, whichever is less, shall be qualified as deduction under section 80C. So at the end, These are the various deductions that are available to an assessee. Assessee can be individual or HUF. These deductions are available under section 80C. An assessee can claim these deductions, the total amount deposited in various approved saving schemes as discussed, or rupees 1,50,000, whichever is less, shall be allowed as deduction. Thank you very much.